Say 3 pieces of advice you would give to people who are looking to succeed in business.
Well, by far the best investment you can make is in yourself.
Welcome back to the channel, everyone. Today, we're diving into the world of one of the most successful investors of all time, Warren Buffett, known as the Oracle of Omaha. Buffett has amassed a fortune of over $100 billion by making smart, calculated investments. But what are the secrets behind his success? What strategies does he use that have allowed him to outperform the market consistently over decades? In today's video, we'll explore Warren Buffett's investment strategies and uncover the key principles that have made him one of the wealthiest people on the planet. So, grab a notebook, sit back, and let's unlock the secrets of Warren Buffett's investment approach. Warren Buffett is often associated with the concept of value investing, a strategy he learned from his mentor, Benjamin Graham. Value investing is all about finding undervalued companies that are trading for less than their intrinsic value. Buffett looks for stocks that are being sold at a discount relative to their true worth, and he believes that in the long run, the market will recognize these companies' true value, leading to substantial gains. Buffett once said, "Price is what you pay. Value is what you get." This means that a stock's price isn't necessarily an indicator of its actual value. By focusing on a company's fundamentals, such as earnings, dividends, and growth potential, Buffett can determine whether a stock is a good investment, even if it doesn't look attractive on the surface. One of the key concepts Buffett emphasizes in his investment strategy is the idea of a moat. A moat refers to a company's ability to maintain a competitive advantage over its rivals, protecting its market share and profitability. Buffett is particularly interested in companies with strong brands, loyal customers, and a unique product or service that sets them apart from the competition. For example, think of companies like Coca-Cola, which has a brand so strong and recognizable that it's hard for competitors to take away its market share. Or consider Apple, whose loyal customer base and innovative products keep consumers coming back. These companies have wide moats, which make them attractive investments for Buffett. A wide moat helps ensure that a company can withstand economic downturns and fend off competitors, making it a safer and more profitable long-term investment. Another cornerstone of Buffett's investment strategy is his focus on the long term. Unlike many investors who are looking for quick profits, Buffett's approach is to buy and hold. He often says that his favorite holding period is forever. This means he's not interested in short-term market fluctuations or daily stock price movements. Instead, he looks for companies with solid fundamentals that can generate steady earnings over the years. Buffett's patience allows him to take advantage of compound interest, which Albert Einstein supposedly called the 8th wonder of the world. By reinvesting dividends and holding stocks for the long term, Buffett lets his investments grow exponentially. This long-term perspective also means that Buffett can remain calm and avoid panic during market downturns, which is a crucial trait for successful investing. One of Buffett's famous pieces of advice is to invest in what you know. This means focusing on industries and companies you understand well. Buffett avoids complex businesses that are hard to understand or predict. Instead, he invests in companies with straightforward business models that he can easily analyze and evaluate. For instance, Buffett has famously avoided investing in the tech sector for many years because he felt he didn't understand it well enough. Instead, he focused on companies in industries like food, finance, and insurance, where he had a deep understanding of how these businesses operated. By investing in what he knows, Buffett minimizes his risk and increases his chances of making profitable investments. Buffett places a high value on the quality of a company's management team. He looks for businesses run by competent, honest, and shareholder-friendly managers. For Buffett, good management can make a significant difference in a company's success. He often says that he would rather own a great business with a mediocre manager than a mediocre business with a great manager. But his preference is to find both great businesses and great managers. Buffett also appreciates managers who think like owners and have a significant stake in the company. When managers own a substantial portion of the company's stock, their interests align more closely with those of shareholders, which can lead to better decision-making and a focus on long-term value creation. A fundamental principle of Buffett's investment strategy is his aversion to excessive debt. Buffett prefers companies with low levels of debt because it provides a margin of safety. High levels of debt can be risky, especially during economic downturns, as they can lead to financial distress or even bankruptcy. Buffett looks for companies with strong balance sheets and healthy cash flows that can sustain operations without relying heavily on borrowed money. By investing in companies with low debt, Buffett ensures that his investments are more stable and less vulnerable to economic shocks. Warren Buffett is known for his contrarian approach to investing. While many investors panic and sell during market downturns, Buffett sees these periods as opportunities to buy. He believes that when the market is fearful, prices often fall below their intrinsic value, creating buying opportunities for value investors. One of Buffett's famous quotes is, "Be fearful when others are greedy and greedy when others are fearful." This means that when others are selling in panic, Buffett is looking for bargains. During the financial crisis of 2008, for example, Buffett made several significant investments, including in companies like Goldman Sachs and General Electric, which paid off handsomely when the market recovered. Dividends are an important component of Buffett's investment strategy. He likes companies that generate consistent cash flow and return a portion of that cash to shareholders in the form of dividends. Dividends provide a steady income stream and can help boost overall returns, especially when reinvested over the long term. Buffett's company, Berkshire Hathaway, has benefited greatly from dividend, paying stocks in its portfolio, such as Coca-Cola and American Express. These dividends provide a stable cash flow that can be reinvested into new opportunities, further compounding Berkshire's growth. Buffett's investment philosophy is based on independent thinking and avoiding the herd mentality. He doesn't follow market trends or fads, but instead focuses on his own analysis and research. This contrarian approach has allowed him to make investments that others might overlook or avoid due to market sentiment. Buffett's ability to stay disciplined and stick to his investment principles, even when they go against popular opinion, has been a significant factor in his success. By not following the crowd, Buffett avoids the pitfalls of market bubbles and speculative investments. Even Warren Buffett isn't immune to making mistakes, and he's the first to admit it. However, what sets him apart is his ability to learn from his mistakes and use them as valuable lessons. Buffett analyzes what went wrong with his investments and takes those lessons to heart, ensuring that he doesn't repeat the same mistakes. For example, Buffett has acknowledged that his investment in Dexter Shoe Company was a mistake, as the company eventually went out of business. However, he used that experience to refine his investment criteria and avoid similar pitfalls in the future. Warren Buffett's investment strategy is remarkably simple and focused. He avoids complex financial instruments, exotic investments, and speculative ventures. Instead, he sticks to a straightforward approach of buying high-quality companies with good fundamentals at reasonable prices. Buffett's simplicity extends to his personal life as well. Despite his immense wealth, he lives a relatively modest lifestyle, which reflects his belief in focusing on what truly matters. By keeping his investment strategy simple and avoiding unnecessary complexity, Buffett can make clear, rational decisions that have contributed to his long-term success. So, there you have it. The secrets behind Warren Buffett's investment strategies. From value investing and long-term thinking to focusing on quality management and avoiding excessive debt, Buffett's approach is all about patience, discipline, and a deep understanding of the businesses he invests in. By following these principles, Buffett has built a fortune and left a lasting legacy in the world of investing. Remember, while we can learn a lot from Buffett's strategies, it's important to tailor your investment approach to your own financial goals and risk tolerance. What works for Buffett might not work for everyone, but his principles offer valuable insights that can help any investor make smarter decisions. If you found this video helpful, please give it a thumbs up, subscribe to the channel for more content like this, and leave a comment below letting us know which Warren Buffett strategy you found most interesting. Thanks for watching, and we'll see you in the next video.